So again, good afternoon. Thanks for joining us for today's short webinar. It's just named a strategy for success for your privately held company clients. My name is Gary Dehart, and I'm the publisher of Insightful Accountant and host of the Accounting Insiders podcast. Today's speaker is Don King. Don is a partner with B2B CFO, and B2B CFO provides strategic business advisory services to owners of privately held companies with a focus on increasing cash and company value. So by redefining the way that services are provided, the way these services are provided, B2B CFO has created a new industry which they dominate and they lead. And they have a nationwide presence. Don is here with me in the Atlanta, Georgia area on the northern side of town. And so Don, appreciate you taking some time out. I do have actually a couple of housekeeping. This is a shorter webinar, so we do not have CPE. If you do have any questions, we ask you to put them in the Q&A panel. And then if you do that, make sure you're real specific in your question. So don't just say, "What do you mean by that, Don?" Because he may not answer the question when you write it. It may be 5-10 minutes later before he gets to it. So be real specific in your question. And then we will, again, try to get to those as we go through or at the end. So Don, before we kick this off, one question for you. And since our core audience is primarily accounting professionals on the public side. So are you competing with accounting firms in what you do, or are you partnering with accounting firms?
Not competing at all. We partner with CPA firms, both large and small. We provide more management advisory and strategic business advisory services to companies. So typically, CPA firms are a good referral source for us, and we're a good referral source for them as well.
Okay,
fantastic. It works out pretty good.
Well, great. And then if down on the bottom of your tray, you should have share screen.
Yep.
Mine's a bright green button. I'm going to go ahead and go dark because this is it's your show. So I'll go dark. I'll be here in the background. And did we have? We do not have poll questions. Okay, great. All right. Well, I'll be dark. If you need me, just give me a shout because I will be. I'll still be here. But thanks, Don. Appreciate it. And
thank you, Gary,
everybody, for your patience just while we got logged in.
Okay, let me pull this up and go to this presentation and put it in presentation mode. Again, my name is Don King. I'm a partner with B2B CFO. We provide strategic business advisory services to companies, privately held companies, typically under $100 million, but it could be any size business. We have clients that are as small as a couple $1 million as well. One of the things I want to talk to you about today is focusing on the things that are important to a privately held company. And to start off with, rule number one for a company is not to fail. And that sounds pretty basic, but most companies do fail. It's no secret that 50% of privately held businesses don't make it through the first 5 years of their existence. These are all facts that are available out on the internet and widely shared viewpoints about smaller businesses especially. But most companies, 50% of companies fail in the first 5 years. 70% of privately held businesses fail in the first 10 years. And a large part of that, we'll get into some of the reasons why they fail. But we'll be going through that shortly. The more than half of the privately held businesses are not profitable. They may be generating cash from time to time and throughout their lifespan, but it doesn't mean that they're actually creating value and they're actually profitable businesses. And it shouldn't be any big secret that most privately held businesses that fail they actually do run out of cash. And that's what part of what I want to talk to you about today. So what, with that information in mind, it seems pretty bleak, but a lot of businesses are successful. And so what do we do to help businesses become successful in their ventures? Privately held businesses, it's important they have a trusted and knowledgeable set of advisors to help them out. It's as they grow, they need attorneys, they need accountants, they need tax advisors, they need business advisors that can help them overcome the hurdles that we all face, or that privately held businesses face as they're going through different stages in their life cycle. Three main areas of focus that within B2B CFO, we've done a lot of research over the past 4 or 5 years, and there's a couple of areas that are of keen interest to privately held to owners of privately held businesses. One of which is cash. Where does the business get cash, and how the cash is used in the business? That's obviously important, and we'll go into some more details there in the next few minutes. The other area of concern is financial performance. How is the business doing? Is it from a P&L perspective? Is it performing well? As far as the income statement goes, is the business actually making money? Those are things that seem pretty. That's something that seems pretty basic, but it's not always intuitive, and a lot of business owners have a hard time managing the business in understanding how the scoreboard, i.e., the income statement and the balance sheet, are performing relative to the performance of the business. They may feel good about increases in sales and expanding customer base, but that may not always translate into favorable for financial performance. Second area of focus is the balance sheet. Is the company utilizing its resources effectively? It may be nice to have a lot of shiny equipment and a lot of fixed assets, but is that the best use of the company's resources? Looking at working capital, is it effectively deploying working capital throughout the company, and is it managing the working capital effectively? What's the equity in the business look like? Has it been making money over the years? Is it struggling? And so if an owner of a business is not adept at understanding the income statement, is very likely not going to understand the balance sheet. But they will likely understand the issues or the symptoms of a poorly performing business, but they don't understand. They may not have a full grasp of what the disease is and where to go look for the problems, which would be the income statement, the balance sheet. And finally, another area of concern that needs some focus within a privately held business is strategy. What are the goals and aspirations of the company? Is there a transaction in the horizon, 3 to 5 years out? Are there aspirations to grow the company and double in size over the next 5 years? How does that affect a cash strategy? How does that affect the balance sheet, or the fixed assets being loaded up on the balance sheet to support strategic growth in the company? Or they being put on the balance sheet, could they be a drain in the valuation of a company in times to come? Is the working capital being managed properly, and so on? All that's important to understand in helping a business owner manage his cash and his financial performance. And so going deeper into the managing the cash, the sources of cash, let's talk about that for a minute. Internal sources of cash, cash flow from operations. Where is the cash coming from in the business? Ultimately, the business should fund its own success and should be able to fund itself. And those funds will be coming from the customers and through cash flow from operations. It's important to understand the cash flows, the seasonality, the things that influence the cash flow of the business, and the cash flow from operations should be able to fund some growth and seasonal influences. And but those will be challenges as the company grows. The seasonality can be more pronounced. The growth could be too much of a burden on the business. But generally speaking, the business should be able to fund itself in a steady state. And growth and seasonality need to be clearly understood and addressed either through cash flow from operations or external sources of cash. And we're thinking of external sources of cash. We can talk about debt or bank financing. The short-term external sources of cash, a line of credit, would be ideal to funding working capital and seasonal needs of the company. So we have a short-term source of cash addressing the short-term issue within the company. And long-term sources of cash, term loans, and long-term financing should be used only to fund long-term issues in the company, i.e. growth and capital expenditures that support the growth. Ongoing capital expenditures that don't support growth but are more routine capital expenditures should be funded through the cash flow of the business and not necessarily through bank or long-term financing of the company. So we're matching short and long-term sources and uses of cash. That's pretty important. Final source of income or source of cash for the business is equity. Obviously, that's owner-infused capital. It's the owner of the business in the position to put capital in the business. They should have some capital tied up in the business. Another source of equity would be to bring a new owner or investor into the business. And these sources of capital should be used to finance long-term needs of the business. If you're using equity to finance short-term needs of the business, then you have a performance issue, which we'll get into some of those later. But if you're using equity to fund short-term needs, that's a bit of an issue as well. Equity should be used to fund long-term and strategic needs of the business. So moving along a little bit on the uses of on managing cash, short-term cash, to summarize, short-term cash should be used to fund working capital, cash flow from operations, and should be used to fund working capital along with funds short-term debt from a line of credit. Long-term sources of cash, debt, and equity should be used to fund growth, capital expenditures, and the overall growth of the business. And again, it's important to match short-term sources and short-term needs with short-term needs, and long-term sources with long-term needs of the business. So how do we manage cash? within the business. Internal sources of cash, cash flow, i.e. cash flow from operations, to properly manage this part of the business, we really need a strong understanding of how the balance sheet and income statement work together. And how the income statement feeds into the balance sheet. We should be following prudent business procedures and managing working capital, making sure that we're billing everything we should be billing, making sure we stay on top of payables, and making sure that we are not mixing long-term debt on the balance sheet with short-term sources of capital, like lines of credit and such as that. We should have budgets that include both the income statement and the balance sheet. From there, we'll be able to project what our cash flow from operations would be or should be, and what our expectations are, and understand any kind of seasonality that might impact the business. Robust reporting of actual versus budget throughout the year, having a thorough understanding of what direction the company's going in. And we should also have a short-term rolling forecast for cash. Gives you a pretty good idea of where things are going in the near term. And so here we are sitting here in June. If a business owner is concerned about cash but has a rolling cash forecast, budgets that he is fairly confident in, and he would know that in September he should be okay cash wise, or he might not be okay, and he can start responding or reacting now to what might be an issue down the road, which would potentially avoid any kind of issues that would be coming down the road. And all of that's really looking at the internal sources of cash, and ways in which we can better manage that cash and have a better understanding of what's going on with cash flow. On the external sources of cash, debt and equity, we should have strong relationships with banks. We should have a thorough understanding and make sure the owner of the business has a thorough understanding of the bank's requirements for lines of credits and term loans. It's worked with many business owners who did not understand why the bank was not pleased with them or pleased with the performance of the business. And it's if a business owner and the management inside the business can anticipate how a bank might react to certain circumstances, they can get out in front of it, have conversations with the bank, and the ongoing dialogue with the bank is very important. Banks don't like surprises, and by staying out in front of these things, you can let the bank know, that kind of demonstrates to the bank that at least you know what's going on. You may not be able to control everything. You may not be able to change everything, but you understand things that are happening inside the business, and you're avoiding surprises. And that's, from a banker's perspective, that's always a good thing. And as we said earlier, the equity holders, it's important to understand where the equity holders are in terms of their ability or willingness to infuse cash if needed. And that's ties back to the relationship with the bank as well, that bankers the bank would take great comfort knowing that if need be, the equity holders of the business could infuse cash as needed down the road, which would alleviate some of the exposure that the bank has. So that's our conversation about on the cash side. And now moving over to the financial performance, the actual financial performance of the company. The income statement, we should have financials prepared in accordance with GAAP, with few exceptions. Smaller businesses are going to have a hard time maintaining a GAAP financials all the time, or they may not produce financials that are completely in accordance with GAAP. There could be some. It could be cost prohibitive. It could be that there are certain things that they'd rather see done differently. There could be some, the reporting could be based at least partially on tax code rather than GAAP. So it doesn't have to be strictly GAAP, but it needs to be directionally in line with GAAP. And as the company gets larger and the issues become more pronounced, banks are going to have less and less of a sense of humor with too many deviations from GAAP. Financials should be prepared monthly with annual budgets. I've gone into companies that were way larger than they needed to be and did not have monthly financial statements. Some of these companies were $100 million plus in revenue, and they could get financials whenever they wanted, but they didn't have a monthly financial package they put together. They didn't have annual budgets, so they didn't have expectations in terms of what the business would be doing throughout the year, and they didn't have a formal process of monitoring the financial performance throughout the year. That's all important. So a meaningful review process. The owner of the business should be explained, and the key personnel, whoever they might be, should be explained what is going on with the business throughout the year. It's that's important, and they should have a good understanding of what the areas of focus that they have. They may be focused on strategic issues like growing the customer base or growing product lines or expanding the footprint. They need to understand how that coincides with the financial position of the company on a regular basis, and there needs to be a meaningful process that they go through. They should have a clear understanding of where the company is relative to where they thought it would be as they go throughout the year. And the advisor should be able to articulate this to the owners, and the owners should absorb this and make adjustments as necessary. They should understand how their business is performing relative to similar companies in the industry, similar size, similar in industry. That can shed a lot of light on their working capital. It can shed a lot of light on their investments in fixed assets. It can provide them with some insight as to whether or not their gross margin is where it needs to be, whether they're top heavy on salaries or whatever the case might be. But it's useful information to have, and stuff that an owner of a business can respond to. They should have a clear understanding of the performance of the company relative to the prior year. Where is the company going? Are sales going up or down? And this ties back to the industry as well. Is the industry expanding or contracting? And are they growing the top line at 2%, but growing all the expenses by 10%? So that would give them an indication of where they might be experiencing margin compression and so on. So it's important to have a pretty good idea of where the company is going relative to a budget. So the budget is setting expectations for the current year in terms of the financial performance of the company. So we've looked back at last year. We've looked at other companies. Now how is the company doing relative to what we expected it to do this year, and what do we need to do to right any issues that may be surfacing there. So identify favorable and unfavorable trends, and manage the revenue, gross margin, SG&A separately, but manage them against these trends, and not try and manage just the top line and the bottom line, but manage the components of the P&L. But manage all of those elements, the revenue, gross margin, and SG&A relative to the industry, relative to last year, and relative to what we thought the budget might be for those items. And as we go throughout the year, it's also important that we react to what's happening to the business relative to our expectations in a thoughtful way, and that we're not reactionary, we're more strategic and in our actions. So don't go in and start cutting costs. Don't treat a short-term issue with a long-term solution. That may end up making matters worse. So having a well thought out process by which you respond to these things, and essentially trying to mitigate downside trends. And so if we do see trends going in a bad direction, if we do see revenue softening up, or we do see certain types of expenses moving in an upward direction at a higher rate than we're able to move the top line, then we need to think of ways. We need to work with the owners of the business to encourage them to think of ways to mitigate that and deal with those costs in a strategic fashion, such that we're not hurting the long-term viability of the business. And we also want to take advantage of upside trends. If we're seeing things happen in the marketplace, if we're seeing the top line move rapidly, then it may be time to expand the footprint. It may be time to invest in capital. It may be time to be looking for expanding the workforce. So dealing with those types of issues, all of that is important in the financial performance of the company. The moving on to the balance sheet, the balance sheet should be prepared in accordance with GAAP, same as the income statement, with few exceptions. Monthly and annual budgets. So a lot of companies will do budgets for their P&L, but they won't do it for their balance sheet. But if you got a cash problem, there's a strong likelihood that the cash problem is on the balance sheet. It's probably tied up in working capital in some fashion, or it may be coming from the P&L, but it may also be coming from the balance sheet. You may be too heavily invested in AR. You could be too heavily invested in capital equipment, CapEx, and you may see the issues there more so than in the P&L. And it's important to look at the balance sheet. I've worked with many companies that the owners just did not understand the balance sheet, and we made that a priority for them to understand the balance sheet and how it's used, because that's what an investor would be looking at, and that's what their bankers were looking at. And their bankers were frustrated more so with the balance sheet than they were with the P&L, or as much so with the balance sheet as they were with the P&L. And it's so you ignore the balance sheet. The making sure there's a clear understanding of working capital. I joined a company about a dozen years ago, and there was a lot of billing that hadn't taken place, and customers can't pay you if you don't bill them, and so there was the investment in working capital was way out of control, and the certain just routine period expenses were having to be funded out of equity because the customers were not being billed and we weren't collecting the money. So after we went through that process and explained how that falls out on the balance sheet, a stronger appreciation for working capital became paramount with the owners, and they learned a lot about the balance sheet when we went through that process, is that they were having to write checks that they did not intend to have to write. Where there are variances in the balance sheet, working capital, capital expenditures, payables, cash flow, all of that needs to be understood and then plans put in place to react to it. If a business is growing, we need to understand, either growing or shrinking, we need to understand what the short-term impact is going to be on working capital. I've worked with a business that grew rapidly. The owners were very excited about the growth potential and had no concept of how much working capital that was going to tie up, and it tied up a lot. And but we did put a plan in place. We did understand what was going to happen. Tied that back to a conversation with our bankers, and as we signed a contract, we got basically a bullet loan that was tied to that contract and could only be used in funding issues relative to that contract. So, but by looking at that up front, understanding what the impact was on the company of that specific growth, we could articulate that to the bank, and the bank appreciated that conversation and was able to work with us because clearly we understood what was going on in the business. Clear understanding of fixed assets and long-term debt. The business owners need to be able to understand what is required to run the business, what is the appropriate level of investing in the business, anticipate what the needs will be in terms of funding for that, for those investments, and how that money is going to be coming back to the business, and tying it back to the top line. So again, just like with the P&L balance sheet, as we want to mitigate downside trends and take advantage of upside trends. And some of these trends are just they may not be upside or downside unless they're ignored and not dealt with, and then everything becomes downside if you're not ready for it. So that's a big part of managing the balance sheet, is just understanding what's going on and what the trends are and what you can do to mitigate exposure and surprises. Good surprises are often as embarrassing as bad surprises if they're not understood and anticipated. From a strategic planning standpoint, we should be able to advise companies, understand where companies want to be in 3, 5, 10 years, what their objectives are. Is short-term, we should have short-term and annual and long-term plans. And in developing these plans, we can help owners anticipate what the future might bring to them. If we're helping owners with both short-term and long-term, uh, planning. And the long-term planning, we can help them anticipate what the value of their company might be over time, and understanding what the levers are that impact that value. The investments in the company that they make today could have a huge impact if they're planning on selling the company in 3 to 5 years. There may be things that they could do today, investments they can make today, that would have a tremendous impact on the business. And it may be best to make those investments now, grow the top line, put the margin in place for a couple of years, as opposed to waiting till year 4 to make investments. You could be late to the dance, but that's why you want to look at this stuff well in advance and have these plans. And if you have a plan, a 5-year plan, and year 1 goes according to plan, then there may be things that you would do based on year 1 doing well. There may be things that you would do to anticipate it for an anticipated sale, maybe 3 or 4 years out. But if year 1 doesn't go according to plan, then you may want to make different types of adjustments. So it's important to go through that process and take business owners through that process. Preparing for the next stage in the business cycle is very important. Anticipating, when there might be a downside, anticipating when interest rates might be going up. You may not want to load up on variable debt in a time period when you think that the prime rate might be going up 4 or 5 points over the next couple of years. And so anticipating some of those things would help the business as it moves forward. The looking for opportunities to grow the business. If we want to triple the business in 10 years, it's going to get there gradually. So we should be looking now for opportunities to expand, whether it's geography or penetrating the current market served deeper and just growing market share. Business owners need to understand what their options are there and what they need to do to grow the business. Could be changes to the business model. I'm working with somebody right now that a business that's primarily in a single market, and they've saturated the market and they are anticipating growing into other markets, and they're struggling with how to do that, and organizationally. So all those issues need to be brought to the surface and fully vetted with the business owners. At the end of the day, what you're trying to do is maximize value for the company, and modeling out how that happens, how you would do that is important for the business owner, and having those strategic conversations is important. As a company grows, the administrative function, one of the things to think about is that the administrative function needs to scale with the business. And you can't just, the controller that you had when a business is a $3 million company may not be the same controller when it's a $32 million company, and or $22 million company. And a lot of companies can grow that fast. They just can't let the administrative function get away from them. That the entire organization needs to scale with the top line and the complexity of the business. In working out the strategic view of the company, it's the things that business owners can be looking at are going to be a sale, merge, acquisition, possibly an ESOP. All of those have all of those different paths have have a huge impact on all the other things that we've gone over today. And getting a business owner to start with the ends in mind helps the advisors support the business in a much more meaningful way than just bouncing along with the business and answering questions as you go along. It's important that as the business is moving forward, that the advisor and the business owner have at least some general understanding of where the owner wants to take the business, because that does influence could influence some of the other capital decisions and strategic decisions that would be made through the earlier years as the company is maturing. So that brings us to our rule number 2. Rule number 1 was all businesses that rule number 2 is that, in the world of business, we're here to play to win, and cash, obviously cash is very important. Know where it is coming from. Cash flow from operations, banks, equity, know how it is being used, whether it's growth, capital expenditures, seasonal working capital, have a really good understanding of what's going on with the cash. Financial statements, prepare, review monthly, understand revenue and costs, understand variances and expectations, and why there are variances, and have specific action items in place to mitigate downside and take advantage of upside. Understand correlations between the financial performance and available cash. Takes a lot of risk off the table. Helps owners sleep at night, and it allows for a much smoother journey for the company if you have a really good understanding of these issues. Strategically, have a clear direction for the company. Where is the company going? When does it want to be there? And does the owner know? He may not know. He or she may not know where they want to go. And that's okay. But at least you got them thinking about it. And so what does success look like for a company? There should be some sort of a scoreboard out there, or you got to know whether you're winning or losing. And that's more of a inner thought for the business owner, but they really need to know whether they're moving in the right direction or not. And it's a little bit about me. My name is Don King. I'm a partner with B2B CFO. We help business owners improve cash flow, grow profitability, and plan strategically. I think we've been through all of this as we talked through this presentation. We also help business owners obtain bank loans. We spend a lot of time working in the space between business owners and banks. We help business owners increase the value of their companies. I don't know of any business owner that wouldn't want to increase the enterprise value of his company, regardless of when he plans on capitalizing on it. And we help business owners prepare a business to sell at some point. At some point, everybody's for sale, and so we help them prepare for that as well. And that is the end of the presentation. I don't know if we had any questions there.
We did have one about whether or not we could share the presentation or the slide deck itself.
Sure. I'll however you want to handle that. I can send it to you, and you can.
Yeah, or you can just drop it in the chat. You can, if you just click on chat, and then that chat box, you'll see there's a blue box that'll say host and panelists, change that to everyone.
Yep.
And then there's a like a little paper emblem.
Yep.
A smiley face. Click on that, then you can just upload the doc from there.
I will do that.
Yeah. A couple things that stuck out to me when you started off, you had that don't fail, number one. And you added, you had, a trusted, knowledgeable advisors, which are critical. Two things I added to that just in my notes were proactive and responsive advisors. So I think that is so key for, again, we're a small business, but so key for a business owner to have that trusted resource who's also going to be in the background going, oh, by the way, hey, we talked about this last week and you still haven't done it, right?
Yeah.
Versus 6 weeks go by and the business owner gets a phone call or an email, hey, you never sent that. Well, you know what? Give me a little nudge.
Yeah.
I need your help, right? When you're looking at you mentioned cash, performance, and strategy. How do you prioritize, or how does an advisor prioritize which of these areas? Because you mentioned teaching clients about the balance sheet, P&L, and working capital. Like, how would you approach that? Obviously, we can't cover everything at one time or in one meeting. And if I'm coming in as a business owner and I'm not too knowledgeable on any of it, I just know how to make great cakes, right?
Yeah.
How would you advise other accounting professionals to walk through that? Is there an order where you would start? P&L, balance sheet?
Yeah, so it could actually be different for different businesses based on whether it's a balance sheet or a P&L issue for that business. We actually have proprietary software that we drop 2 years of their financials into, and it compares and it creates a gap analysis, what we call a gap analysis. And it ranks that business against its peer businesses in the same size and same market. And it points you in the right direction, whether you have a balance sheet issue or a P&L issue. But I would look at the balance sheet and the P&L, compare that to what what information you have available with other companies, and use that as a reference. Oftentimes when you come back to the business owner with a recommendation that this is where we need to focus, they know that. They just don't know how to know that. They don't understand how you got there. You go to the doctor and you got a problem, you got a problem. You just don't know what it is.
Right.
The doctor is going to tell you what it is. And that's kind of what we are for businesses. We get symptoms and we determine what the disease is. And then we start treating the disease.
Gotcha. Okay. Any other thoughts before we wrap up? Oh, and actually, can you drop that presentation into the...
Yeah, I'm doing it right now.
Oh.
Okay, and that should be there.
I don't see it yet. You may hit return.
Just a second.
Okay. And you can also, if you want, you can, if you just send it to me, then I can include it in the follow-up email.
Yeah, let me do that. It's for
Okay.
some reason it's not.
All right. Well, very good. Well, I certainly appreciate you spending some time today, Don, going over this. Do you have a slide that does have your email address on there, just in case
Yeah.
people want to get in touch with you?
Yeah, I'll make sure that's included.
Okay, great. Well, that will be sent out in the next 24 hours or so. Again, thank you, Don. Thanks for our attendees for taking some time out of your day to join us. And we are going to go ahead and call it a wrap. Again, thanks a lot. Appreciate it.
Thank you. Bye-bye.